Welcome back. You're with the home loan special edition of Money, Money, Money. Well, to switch or not to switch, that becomes the multi-thousand rupee question. We've got Mr. Dinesh Kumar Khara, Managing Director and Group Executive, Associates and Subsidiaries at State Bank of India joining in. Of course, SBI really started the bonanza, the big announcement on the 1st of January with a big rate cut. Mr. Khara, sir, the question for a lot of our viewers is whether to switch or not to switch. What are you telling your existing borrowers?
Yeah, I think it makes sense to switch. That is something which we would like to have our existing borrowers also, because it's a steep rate cut which we have announced, and also it is we have come out with a product which offers 2-year fixed rate, and also after 2 years it is linked to the MCLR. So I think we would very strongly recommend people to switch also.
So if existing borrowers on the old regime, the base rate regime, if they were to switch to the new MCLR regime, so what are the kind of costs involved at State Bank of India?
It could be around, I think, approximately around 10,000 rupees. Yeah, that is the kind of a cost which should be involved.
Okay, and what do you envisage? I mean, this 8.65 number, is it pretty much as good as it gets, or do you see rates heading even lower from where we are given the environment?
See, actually, as of now, much of it is a function of how the demand evolves as the credit is concerned. So, I think as of now, it looks like that for the time being, it should be around this range only. But maybe going forward, it's anybody's guess how it will evolve, depending upon how the demand is.
All right, sir. Thanks so much for taking this call and explaining that to our viewers. So there we heard State Bank of India also advocating a switch for existing borrowers. So let me start with you, sir. Now, how does one start doing the math? Because if I am an existing borrower, I'm guessing the outstanding life of my loan, I mean, the number of years left, that will also have a bearing on the decision, won't it?
Absolutely right. Surbhi, there are quite a few things one has to keep in mind while switching. The first thing is when you switch, what is the type of loan you are getting? Are you getting a floating loan, or you are getting a part fixed, part floating? Because then you also need to understand that if it is part fixed, part loan, and during the fixed tenure, if you want to again switch over, then there is a penalty.
Okay.
Most of the banks will levy a prepayment penalty during that time frame.
You know, before I let you carry on, let's get this out of the way. Adil, why would one right now opt for this part fixed, part floating product at all? I mean, if at all. And most banks are offering this. Loans can be fixed for the first 2 years, or in some cases 3 years or 5 years, and then the loan becomes floating. Does this product make sense to you at all right now, given the environment?
Depends on the consumer. If you want to lock in your EMI for the next 2 years, not have any risk of it changing, and you think 8.5% is a good offer, then you sign up for a 2-year product.
At least for 3 years, you're locked in at 8.6% or whatever is the prevailing rate then.
Pretty much, yeah. Right? So if you feel that, hey, this is as good as it gets, I want to lock in and for 2 years I don't have to worry about it, then you take it. However, if you are someone who feels that rates will fall lower, then you probably should go with an all floating, yes.
Okay, sorry sir, I interrupted. To come back to your point, so then, you know, how do we come to this decision of, you know, how to switch and whether it makes sense?
Exactly. So that's first point. The second point is it also depends at what stage of your loan you are in. See, one has to remember that this is EMI. So in the earlier part of your loan tenure, you are paying huge amount of your EMI is going towards interest payment, and very less towards your principal repayment. And as you move into the end part of your loan, higher amount of your EMI is going towards your principal outstanding and lower towards the interest. So overall, in the earlier part of the loan, if you switch over, it makes sense because a large part then goes towards the interest payment. And as you move towards the end, it really doesn't make too much of sense to move. Third is also the tenure which is being offered, because, you know, at the end of the day, it is the EMI to a lot of people which determines how they are going to pay off their loan. Now, if they are going to get a tenure which is perhaps less than what they are looking at, then it may swell their EMI, which may then impact in terms of how their monthly budgets are.
Sure.
So these are some of the things which one obviously has to look immediately into. Apart from, are there any other costs with respect to, processing fees, or is there any, once you get the documents, is there a memorandum of entry which needs to be done? In some institutions insist that there has to be an MOE, which means there is a stamp duty implication. Now, those are the things you come to know when you actually do a transfer. So these are some of the quick checklist which one can always do before you embark on that balance transfer.
So I think I noted 4 very important points there. First of all, the outstanding tenure of your loan itself. I mean, how much of it is yet to be unpaid. Number 2, the EMI that you're comfortable with. If you're going to take on a new loan which doesn't offer you a repayment of a longer duration, then the EMI becomes too big and it doesn't work. Number 3, one has to be careful about getting into a fixed and floating product, because then there's a penalty involved if you want to make it floating again. And number 4, the costs. So let's take up the 4th point and the cost there. Adil, we just heard the SBI gentleman tell us that there's an overall capping of around 10,000. Is that what you see pretty much across the industry? Because from what I hear, the switching fee or the processing fee can be 0.5% to almost going up to 1% in certain cases of the outstanding amount?
Yeah, you're right. So it could be between 0.5% and 1%. I think 10,000 is like the average amount, and sometimes it typically tends to get capped at that amount, saying that that's what the processing cost of the loan is. I think the SBI gentleman brought up a good point on cost. I think essentially there are 2 costs to switching. So one is the processing fee of the new loan, which is about 10,000 rupees on average. The second is not a financial cost, but the time and effort involved in actually making sure that you apply for the second loan, and if it's the same lender, then the documents don't need to move. But if it's a new lender, that the documents also need to move and some amount of diligence is required. One thing you need to be able to calculate is the benefit of switching. And the benefit of switching is, let's say your EMI is a certain amount when you're paying the old interest rate. By taking the new interest rate, assuming you do it for the same remaining tenor, your EMI should go down, which is the incentive for you to switch. If that saving, which is the EMI saving per month into the number of months left, what that total amount is, and how does it compare to the 10,000 and time required in order to get that benefit. So that's a back of the envelope calculation that one can do online.
Well, I'm going to actually ask you to give us one of those calculation examples in just a bit. But Mr. Mehta, your thoughts on the cost factor. This general industry trend of capping the switching fee at around 10,000, 11,000 odd plus service tax, do you expect this to continue, or could there be a change given the competitive pressures?
See, as far as the costs are concerned for switching, it's pretty much same across, and we believe that given the competitive environment today, I think it will remain pretty much in the same range. However, we also need to understand that these costs can also change depending upon the profile of the customer, and sometimes it is also linked to the loan amount. So this 10,000 may not necessarily be fixed across the entire spectrum of the loan size. There may be a capping. And beyond that capping, if the loan amount exceeds, then it could be anywhere in the range of 0.5 to 1%, which Adil also mentioned about. Second, it is also to do with the type of customer. Sometimes, this largely is around salaried profile. If you have self-employed, then again it could change. So one has to be really, be down to the T to make sure that do the complete math around it to see what are the cost-benefit analysis. Secondly, you keep on switching, also somewhere it shows up in your report. That, and when you do an analysis, you find that this guy has been constantly
tendency to constantly hop. Okay, fair enough. We'll take a break on that. But on the other side, we will get you the specific example. When does the math work in favor of switching your current home loan? We'll be back in a moment.